So our next guest is a regular here on the show. He is a 20-year professional institutional futures trader. He started his career on the CME trading floor and later left open outcry trading pits when electronic trading started and went on to trade futures on the screen for Commerce Bank for 3 years, Cargill for 4 years, and most recently JP Morgan for 8 years. Here's your chance to learn from Michael as he discusses the order flow concepts and tools that he uses and has taught many other successful traders. Michael brings a unique perspective in order flow analysis from someone who's traded for a living at the highest institutional level for over 20 years. Welcome to the show, Michael Valtos.
Okay. Can you hear me okay?
Yeah, we got you. How are you, Mike?
Okay,
How's it
I'm
going,
doing
buddy?
good. I'm doing all right. Happy to be here. It's tell you, man, these every day it's like something new in the markets with with Trump and these politics. It's interesting times to be a trader,
It
definitely.
really is. It really is. I mean, do you believe volatility is still going to continue higher?
Every time you think the market can't go any more crazy, just wait till the next day. You know,
Right?
you know,
Right.
it's just it's fascinating. It's fascinating in the sense of you know the whole how politics is intertwined into the markets. Just this morning, right when we're all asleep in the US, news started coming out that, oh, maybe there's going to be some agreement in China, and you saw NASDAQ just spiked up about 20 handles, which it's just mind-blowing that these moves that happen nowadays. And then you think, well, that's a one-off event, and a day later or the next day later you get another 30, 40, 100-point move in the NASDAQ. It's just great time to be a trader.
It really is. I remember many times, months and almost years at a time, where it's like watching paint dry. So I'll never complain about volatility or action. I mean, that's a fun way to do it. And I think news dissemination. I mean, we know this, right? News dissemination worldwide, the speed of it compared to what it was when you and I started trading is just. I mean, you can't even compare it, right?
Right. I mean, it's you know, I was just talking earlier to my wife about this. I remember back when Greenspan gave his irrational exuberance speech, and
Yep.
that happened like at 9 o'clock Central Time, 9 or 9:30, and the markets just went berserk. And I remember I was working on the trading desk overnight. I would trade, the Asian session into Europe, into the U.S., and nobody knew what was going on. There was no Twitter, there's no Facebook. There was cable news, but hardly anybody really watched it. They would just do stories on, dancing cats and stuff like that. But
Right.
it's now it's like, just like the other day, I remember, I think it was just yesterday, stuff happens so fast it's hard to keep track of the days. Um, you know, One of the guys from the Fed is talking, and boom, market spiked like that. It's whereas in the old days, people would be scrambling around, what's the news, what happened, and it would
Right.
take,
Right.
10 minutes, 15 minutes sometimes to figure out what happened. Now, news just gets out there so fast that, you know, it's it's one of those things where you can't trade around it. You got to react to it, and most importantly, you have to have some risk management in place for it, because that's these moves are going to get it's going to run you over if you don't have any sort of protection, as
For
far as
sure.
stop loss or anything like that.
For sure. And let me ask you a question about that. So I know you trade on order flow and you're really just watching the paper and watching where the money's coming in and out. Do you ever
Hmm.
find that news and knowing what's happening can get in the way, and sometimes it's better to just purely trade on the order flow and just read what the money's doing?
Yeah, it's one of those things, because people always say, do you have a bias coming into the market in the morning? And you do your preparation, and you could spend an hour preparing, and then by 9 a.m., a number comes out or something, or somebody says something, and your preparation is just thrown out the window. And so, you're sort of back at square one. You're better, in my opinion, at least, um, having a trade plan, sticking with it. If the market does this, okay, that's what I'm going to do. If it doesn't do it what it's supposed to do, then okay, I'm going to, do something else, or step away from the screen, reassess. You know, I don't like to get married into a way of thought, especially nowadays with things just happening so fast that. you can, no sense dying on your own sword saying, oh, this market's got to go up, because of everything I've done in my analysis. No, it doesn't have to go up because it could just take one event. And sometimes it's just that one thing that can change the entire outlook of, the market in the near term. Long term, yeah, you may be correct, just like, a good way to think of it is, back in the 2000s, right? And you had the whole commodity run up, but at that time, you also had a lot of hedge funds getting into commodities all of a sudden. So there's a lot of hot money in the market. So, I knew a lot of guys that were commodity traders, starting hedge funds. They would be right on the market prediction, over the 6 month term, but the intraday swings, because all the hot money going in and out of the market, their risk parameters, they'd be stopped out of positions. So they would win the battle but lose the war. So, it's one of those things. Don't get stuck on thinking, oh, it's supposed to do this because, this number came out, yesterday and it is very bullish. But, so even though the market's going down, don't think I got to buy more. There's a reason why it's going down. You may not know what it is right now, but, everybody else has got a better, for whatever way that they trade is, weighing on the market. So, don't, my only advice is, don't get so caught up in, trying to be a hero and predicting, where the market's going to be, down the line, or, say, yeah, I predicted that this market would go up by the end of the week, but in the meantime, you're suffering a big drawdown. It's not worth it. So,
And what about getting caught up trying to figure out why the market's moving versus just watching the paper? Where do you stand on that?
well,
Because
in
you
my
see a lot of
opinion,
people
yeah,
instead of, they get paralyzed trying to figure out, well, wait a minute, I need to know what's happening in the world that's causing this. And then they spend 5, 10 minutes as opposed to your
exactly. Well,
methodology watching the order flow.
if it's one of these things, back when I was a young buck in this industry, I used to tell somebody, a good friend of mine who sort of helped me get in the industry, he said, yeah, I want to learn Japanese so that I can, read the Japanese news. This was back in the 90s, so I could trade Japanese yen. Then I realized that, once I saw, you know a lot of this news that comes out is already baked into how the market's reacting, and if it's not immediately baked in, it's going to get there relatively soon. I think the way, because what moves the markets? It's people, right? It's people reacting, or people have their own point of view, and that's really what's moving the market. So you got to react to that, not off of, oh, there's Trump says no more negotiations with China. Will that move the market? Yeah, of course that's going to move the market. That's an obvious thing. But trying to profit off that in the near term is it's hard. You just got to watch where the flow is going in. It's like if you run a business, just a shop selling fruit or something, you're going to make your decisions based on what people are buying from you. If they're buying more apples, you're probably going to buy more apples to sell to them. If they're not buying pears, you're probably not going to invest so much in pears. And you make your decisions based off of what people are doing in the market.
Makes perfect sense. Last thing I want to point out here before you get going is I just want to do a quick brief just in case people don't know your history. Will you give a 30 to 60-second history
Yeah, I'm gonna
about
give a
oh, you're going to do it anyway. I just want to make sure
yeah.
everybody
I'll
understands your
cover that.
banking history because that's a unique part of what you bring is that most people don't have this Cargill and Commerce Bank
Right.
and JP Morgan. It's extremely rare to find somebody that's out educating traders that's actually been on that side of the desk, right? I mean, I've never even been on that side of the desk. I've always been a local. But to find somebody who's really spent that much time trading money for the huge banks and using all their tools is a really big value that it's very hard to find. So just want to make sure
Okay.
that's covered in your intro. And I will go ahead and turn it over to you now. Let me
Okay.
make you make you an organizer here so you can answer any questions that come in. Anyone that has questions, as you guys know, a few of you did a good job during Nick Santiago's presentation and asked a few questions. We always love when people ask questions. Everybody does. The presenters do, and we do. So the more you can do on that, the better. And I will turn it over to you. And Michael, you've got about 30 minutes, and we'll pick you back up here about 10:55 Pacific, okay?
Okay, great. I just want to make sure you can see my screen okay. I
It
think
says
so.
new advances in order flow.
That's right. All right.
Perfect. Sounds
Great.
good.
Thanks, Jack. All right, guys. So what I'm going to talk about today is the new advances in order flow, and what that means. Order flow is not something that's just been around for the last 20 years. It's been around for well over 100 years. It just hasn't been at this level. And my goal for you today is twofold. One, I'll explain how price tells us what's happening and how volume tells you how it's happening with either commitment or lack of commitment in the market. And also, I'm going to give you two order flow setups that you can start using in your trading tomorrow. It's one thing to learn about order flow, but you want to know how you can use it in your trading. And my goal for you today is to give you two setups that you can look for if you want to add order flow to your trading. They're not overly complicated. They're very simple that you can start using in your trading. And again, if you stick around till the end, I'm going to show you how to get a copy of my book, Trading Order Flow. It's not going to be the actual hard copy book. It's going to be a digital download. It's 150 pages, but it's a good read, if you're new to order flow. So as Jack was explaining, a bit about my background. Most recently, since for probably the last 4 or 5 years, I've been running Orderflows.com. But prior to that, I spent 8 years as vice president of futures trading at J.P. Morgan. I spent 3 years as the licensed Eurex trader at Commerzbank in Chicago. I spent 4 years at Cargill. It's a big commodity trading company. They account for about 30% of all U.S. grain exports, about 25% of all meat exports, but they're in every type of commodity that you can imagine. I was a trading desk manager there. I spent 2 years at EDF Man as a global macro trader on their desk trading everything, all these strange commodities. That's what we traded there. I started on the CME floor with Dean Witter, but I left the floor after about 2 years and I went to their upstairs trading desk when electronic trading started taking off. Being in my early 20s and having a little bit of computer background, I realized, electronic trading is what I want to be into. And I did that starting in the mid 90s and my career took off from there. Now, again, it's important to, the reason I put that up there, this brief timeline of my history is because what I talk about with order flow you know came through working at different trading jobs, working with different traders. We'd always be on the trading desk, shooting around ideas. We all have big orders we got to execute and we want to do it with minimal market impact. Nowadays you have execution algos where you can sort of hide what you're doing, but you know what, all that activity shows up in the order flow. But the thing is, you have to know how to look for it. Now, I left JP Morgan right after my daughter was born, my first daughter, and I was trading order flow for my own account. I started writing my book, Trading Order Flow, which you get at the end, and I was using an order flow software from another company, but all that the software choices that were available were just basic footprint uh, order flow charts, and I was doing a lot of calculations by hand and, in my head, but, I know computers can do that analysis for you. So, I met with a programmer that was already familiar with order flow and a footprint chart, and I said, hey, can you take this form of analysis and put it into the software? Let the software do it for you. And I started talking to some other traders, showing them my charts, and they were like, "Hey, man, can I get a copy of that software?" And that's how Order Flows was born. So, what I'm presenting here is what I've developed for myself, that built my trading career on. And hopefully, you can find things you could use in your own trading or adapt for your own trading. Again, anything anybody says, whether it's me or whether it's Paul Tudor Jones, evaluate it and decide if it's something you can use in your own trading. Now, again, don't take my word for it. A lot of people have been using my software for years, and they tell them it's very helpful in allowing them to see things in the market that they couldn't see before. And that's really what you want, right? You want to be able to see things and understand what's happening in the market. Now, again, before I begin, disclaimer, trading is not for everybody. It takes a certain mentality. It takes a certain dedication. It's not something you could just sit down and start playing. You can't sit down at a piano and just start, playing a concerto, right? You have to understand what the different keys are, what the pedals do, and how to put the different notes together. And it's the same way in order flow. Now, most people think trading with order flow is this, just looking at ticker tape, just seeing the prices go by, but it's not. This is what it looks like. It's like a waterfall of data. And if you're not no human brain can process this information. We all joke about, yeah, I was born in the Matrix, I can figure it out. No, you can't. And why put yourself through that? You're just going to do yourself a disservice and you're going to end up losing money. Now, the problem with trying to read raw data, sometimes it's too messy and it's overwhelming. What you need to do is you need to put it into an easy to read format. And that's what a volume footprint chart does for you. So you can see how trades are being executed in the market. Is it being traded on the bid? Is it being traded on the offer? Is there more aggressive trading? Is there less aggressive trading? Is volume picking up? There's so many little things about the information that you can use and make good trading decisions. So once you have the data in easy to read format, you can begin to understand what's happening in the market. So think about it, right? When you go outside, right, you're going to look at the thermometer, you're going to see what the temperature is. And it's the same way if you're going to take a trade, right? You want to know what's going on in the market. Are buyers being aggressive? Are sellers being aggressive? Is there a lack of buying interest? So many questions you could have depending on where the market is. And that's what order flow allows you to see. Now, very basic stuff. You got to realize, what do we know about how markets trade? Well, trade is conducted through a two-way auction, right? There's a bid price, there's an offer price. So, in this example, say the market is 29.55 and a quarter bid offered at 29.55 and a half. That's the two-way auction. People are happy to buy it at 55 and a quarter. People are happy to sell it at 55 and a half. However, no trade is going to occur until someone becomes aggressive, until the buyer goes and lifts the offer at 55 and a half. He is being aggressive. Or a seller that wants to sell something is going to sell at 55 and a quarter. So once you understand that the market trades in two-way auction, you can understand the different types of traders, right? There's passive traders. They're the traders that buy on the bid or sell on the offer. They wait for the market to come for them, right? They're not in a rush to get into the trade. They're happy to buy it at 29.55 and a quarter. They think, oh, that's what it's worth. That's what it's worth to me. So that's what I'm going to pay. At 55 and a half, no, that's too expensive. Now another trader could come in and say, no, I think this price is going up. I think 55 and a half is a good price, and they will buy it. They're what is called the aggressive trader. They don't wait for the market to come for them. They trade at the market, they buy the offer, or they sell into the bid. If you think that the price is going down, you're not going to just sit on the offer. You want to get in, right? You want to participate in the market movement. So you're going to sell at the bid at 29.55 and a quarter. So once you understand the difference between traders and how they trade against each other, passive buyers versus aggressive sellers, passive sellers versus aggressive buyers, then you can start interpreting the order flow footprint chart. Now, there's a lot of information on a footprint chart, and a lot of people get scared. They see numbers, they're immediately scared of the large numbers. They immediately think, oh my gosh, I got to know math. No, you don't need to know, calculus or anything like that. Now, there's three building blocks of order flow and on the footprint chart that every trader needs to know, in my opinion. And it's the delta, it's the imbalances, and it's the point of control. And we'll go through each of those really quick. So delta is the net difference in a bar between aggressive buyers and aggressive sellers. And it'll appear on the bottom. And you can see it down in here, delta 497, delta 345. Each bar has a delta, 150, minus 71, positive 41. If it's positive, then you're going to say buyers are in control. If it's negative, sellers are in control. Now, in general, there's going to be instances where you have, a down candle, a red candle with positive delta, and that means something. I'm not going to get into that today, but there's little nuances in the order flow that you can profit from. Now, the next thing is imbalances. And again, remember, markets trade in a two-way auction. And what you're doing with imbalances is you're measuring the volume traded on the bid versus the offer. And if it's greater than 4-to-1, in general, you could adjust your imbalance threshold. Some people use 10-to-1, some people use 3-to-1. Then you'd consider it an imbalance. And as you can see, like on this green bar right here, you got 0 against 115, that's an imbalance. 0 against 157, that's an imbalance. These are buying imbalances. up here at the top of the bar, you have 257 against 3. So when it was 174.58 bid offered at 59, 3 lots traded on the offer, 257 traded on the bid. So there was some selling into this bid as this bar was closing. This is a 1-minute bar chart. And it's just telling you, there's things that you could read into that. You can see where price is being absorbed by bigger traders. Now, point of control is a simple one. Every bar has a point of control, and it's the price level in the bar where the most volume traded, and there'll be a box, a rectangle around it. Now, some of these bars, again, this is my own software, okay? So I don't use any other software, but my software, what it will do is if there's a point of control that's either supportive in the market or offering resistance, for resistance, it will color it purple. If it was supportive point of control, it would color it blue. So you'd have support and resistance acting in the order flow. You can see it at an instant. So, the next thing is, one of the reasons most traders fail is because they focus too much only on price, right? Once you understand the relationship between the buyers and sellers at prices, then you start to understand the market. And what I say, most traders become focused on price. They don't take into account volume. The volume that's traded on the bid or the volume that was traded on the offer at that price. Not all prices are created equal. You could have one price that trades 15 contracts where the next price trades 1,000 contracts. Well, that 1,000 contracts is probably very important information. Don't you want to know if there's 1,000 contracts traded at a particular price and the market came off? That's what Jack and I were just discussing earlier is the paper that's coming into the market and paper that's been resting orders sitting in the market. Those are important areas that traders trade around, and I'm going to show you an example shortly. So when you look at an order flow chart, honestly, for most people, first time they look at a footprint chart, they look at this and they just scratch their head, shake their heads. This is stupid. I got time to learn this. Well, you're not analyzing every single price. You got to take into account what you know about order flow and put it in a bigger picture context. Now, if you look at a bar chart, right, this is, what is this, mini Dow, a 1-minute chart, okay? Ask you, by looking at this chart, is there any reason to be buying off this low? Off this low, we had this nice, basically 100-point rally up off this low. As a trader, sometimes you got to be playing detective and sort of putting the clues together as to what's happening in the market. Now, if you're looking at this chart, honestly, I can't see any major reason to be buying off this low at all. If you're using a moving average or something, by the time it's telling you, by the time it crosses above the average, you're already 50 points into the move, and so you've missed it. So look at the order flow. This is the exact same time period. This is that low right here. What do we see? You got to play a game of what do we know? Well, I know I've got my low, but I know I got positive delta coming in at the low. Okay, what does that mean? It means that we hit a new low, but instead of more selling, instead you have aggressive buying coming into the market. You got positive delta, 125. Also in the bar, you're seeing 1, 2, 3, 4, 5, 6, 7 buying imbalances in the bar. So you know that the aggressive traders are active in there. So, once you start putting those pieces together, you start forming a view of the market, right? So your view at this point is, I don't think this market's going to go down. Instead, I think the market is going to go up. Anytime you hit a high or a low, you got to be asking, is this market going to keep going down? Or is this market potentially going to turn around and go higher? And that's where order flow comes in. By looking at the volume that's being traded, by looking at what's going through, you can get a good idea, you get a grasp of what the market participation is, what the commitment of traders is, in the sense that, are traders getting long? And you see here, net traders, net long 125 on this bar on the low. That's important information. It's not negative. If it was negative, I'd be wary that this market still got some selling into it. People are still interested in selling the market. So, what makes order flow so powerful is it allows a trader to see early signs of a move about to happen. We've all looked at charts and said, oh, that was a great move. You could have taken that long because of this or taken that short because of that. But, as a trader, you're in the moment, right? You got to make that decision. And oftentimes you got to make it very fast, within seconds. But you have to know what to look for. Now, this was just yesterday. This is a mini Dow. This is a 1 minute chart. When I before I got into working in the trading industry, I used to keep charts by hand at home. Now there was no overnight session in the sense of no Globex, and so the CME would open, at 7:20 on the currencies and close at 2 o'clock, and that was, for all intents and purposes, the trading session for that day in a currency. You know, people didn't follow the forex markets or anything like that. The only people that traded forex back then were the interbank dealers. And I used to sit there, I used to look at these. You used to get allotted bars like this: open near its low, have a big range, close on its high. And I used to think, gosh, is there a way to see what is about to happen before you get that big move? You know, I would be looking on the charts, and people say, well, you got one, two, three, double, triple bottom. Yeah, okay, and people say, oh yeah, draw a trend line here. Okay, no, I wanted something more definitive. Okay, because you could draw a trend line here, and the market could just hug the trend line and keep going down. And people say, well, you got to trade the breakout. Well, by that time, you gave up, a third of the move already. If you're following some moving average, again, you're giving up a third of the move already. I want to be clued in as soon as possible, because that's where you're going to make more money. Basically, if you're getting into trades late, then it's going to reduce the amount of money that you're going to make, plain and simple, right? This is a 50-point move, but if you get into the move after the market's already moved 20 points, well, you just gave up, 40% of your profits. So, I wanted a way that would allow me to understand what's happening in the run up right before that big move up. And that's what order flow allows you to do. It allows you to see what's happening in the market. Now, this is the order flow chart, right? This is the big bar up, nice heavy volume, but again, a 1 minute chart. So you got a full minute to analyze this. This is not like looking at it on nanoseconds or even milliseconds. I'm just looking at a 1 minute chart. And what do I see? I see right before the big run up, I see this bar. Look, I got 1, 2, 3, 4, 5 buying imbalances in there. So I know traders are being aggressive. I could see the volumes that they're trading, 110, 84. They're just lifting all the offers with impunity. Do you see any type of volume like that immediately preceding? You see 119, 119 and 84. In the earlier bars, what's a big volume? 30 contracts. Here's one with 54, and here's a 40 and 49. But in general, 20 to 30 contracts. Someone just came in and lifted, over 200 contracts right here. They're being very aggressive. I see the strong delta, 194. Do you see any strong delta like that? Well, here's 119. Okay, that's strong. 194 is almost double that. So I'm seeing signs that, hey, you know what, this market is potentially about to take off. Do I want to be long or do I want to be short? We had been trending lower, going down, going down, going down. But then, boom, buyers stepped in. That's what you want to look for in the order flow. So order flow shows you what's happening right now in the market, so you can react right now. Now, this is yesterday. This is the NASDAQ this time. It's a 30-second chart. Okay, people ask, what time frame is best for order flow? Well, if you trade order flow, you're more of a short-term trader. I think anything less than 5 minutes benefits you if you're analyzing the order flow. But that's not to say you can't look at order flow over on a 30-minute chart. There's different ways to use the order flow. A very good friend of mine trades order flow, and he looks at footprints for 30 minutes, but he's looking for very specific things. So there's so many different ways to use order flow. The way that I use it is my way, but that's not to say that's the only way. So here's a 30-second chart. Market's trending down, okay, going lower, lower, lower. I got imbalances coming in here, negative delta. Okay, then we start forming this bottom, start coming up. Okay, so if I'm short, and I see the market going sideways, and do I see anything big in the order flow telling me, stay short? Do I still see negative signs in the order flow? Not really. If I'm looking at the delta, I'm seeing now positive deltas down here. I'm seeing green. So that's a sign that, if I was short, potentially the move is over. So I get to this bar here on the end with the blue arrow. I put the blue arrow so it's easy to see. And what do I see? I see a very strong positive delta, 134. Again, do you see any big positive deltas in here? The biggest one's 27. Nope. 14, nothing. No big positive deltas, but I know buyers are coming in. Volumes picked up 388. In here, I look at the volumes in here, 192, 182, 248, 263, 388, I know people are coming into the market. Are they coming in as buyers or are they coming in as sellers? They're coming in as buyers. What else do I see? I see 1, 2, 3, 4, 5, 6, 7 buying imbalances in there. Okay, so if I was short and I see this bar, throw out my whole short bias. I see this bar, I got to get long off this bar. Right now, this is a 30-second chart, so you got a full 30 seconds to analyze what's going on. Again, I'm not saying that you got to all of a sudden, it's going to take you 5 minutes. It's not. It should take you very quick. You should be able to recognize what's happening and act on it. Next bar, stronger positive delta, 229. Again, another big up bar. This time you got 3 buying imbalances in there. Okay, bars move from basically 67, 68 all the way up to 70s, 74, 73, 74. Okay, so even if you've missed this move right here, right, and said, I didn't get long off this bar. Next bar is up. You're sort of kicking yourself, thinking, oh my gosh, I'm an idiot. I missed it. Well, usually when there's big buying or big selling coming into the market, it takes a while for it to exhaust. All right, look at this third bar here. It goes from about 71 all the way up to 83. Another big strong positive delta. You're looking at 463. So what's happening in the delta? Volume is increasing, 388, 883, 1847. Delta's increasing, 134, 229, 463. And you still keep going higher, right? The next bar after that, 82 all the way up to 94. Okay. But really, you shouldn't be getting in here, up here in the 80s. Realistically, you should be getting in somewhere in this bar between 68 to 74. Even in the next bar, you still had some time to get in between, 71 and 74 as well. And the next thing, within a minute, you're trading in the 90s. Then the next bar finally gets all the way up to 99 and 3/4 and starts dropping back. Okay. The move is finally over. We still got positive delta though, but markets turned down. Now you got, it's probed higher, hit there, and just, started selling off. This is not the time to get into the move. The time to get into the move is right after you start seeing the pickup in delta, seeing the aggressive buying coming in the buying imbalances in there. Then finally the next bar starts coming down. But you had this whole bar, you had 30 seconds to pull the trigger on that trade. This is not a range-based chart or a Renko-based chart where you can get 8 bars in 10 seconds if the market's really moving. This is a 30 seconds. You have time to react. So again, that's just one example. Now, there's a blank slide here. So now that you have an understanding of what order flow is and the key components, you can start understanding what's actually happening in the market. And what I'm going to get into now are some of the setups. So the first one is trap traders. And this type of trap traders, there's different types of trap trading in the market. And I don't like the term trap traders because it sort of connotates some nefarious trading that's going on. But there's times that swing highs or swing lows where short-term traders run into longer-term traders with the opposite view. And those long-term traders are the ones that are going to absorb the short-term traders and then turn the market on them and move it in the opposite direction. So what you're going to look for is point of control on the extreme of the bar, which signifies a longer time frame trader absorbing the short time frame trader. Not everybody trades on the same time frame, and that's a hard concept for a lot of new traders to understand. Everyone thinks that, well, all the banks trade on a 4-hour chart. No, they don't. Or all the banks trade on a 5-minute chart. No, they don't. Everyone has their own different chart duration that they're looking at and makeup. So what you're looking for in the order flow, right? I talked about point of control. What I'm looking for is extreme point of control on a red bar on the top, right? My software will color it in as magenta, purple, so it's easy to see. If it was blue, it would indicate supportive buying. And what else do you see? You see the aggressive selling coming in here. And you just compare what's traded on the bid and the offer, on the way down. So it's telling me sellers are in control here, right? So I know that coming up in here, there's resistant selling. There's somebody up here with offers, right? There's supply up there. Now, on a buy, right, my software will draw a blue, a blue point of control, right? It tells you there's support. So what's happened is you rallied up, market starts coming off, but there's supportive buying here in the market. It's stopping this move lower. So all these people think this market's going down are selling into this bid, but there's some guy there saying, yeah, I buy it, I buy it. And absorbing all that selling that's going on. And sure enough, what happens? Market starts ticking back up. Next bars, boom, on the way up. This is gold that I'm looking at here. It works on different markets. Here's another gold chart. Here, high of the day. Point of control on the extreme. Looking at the volume on the way down, 72 against 55, 68 against 46, 17 against 34, 8 against 1. Right? I know that the sellers are in control. Just looking at the volume horizontally, they're in control as well. What is this one? Crude oil, 1-minute chart. Market's coming down. It starts popping up. Get a little bit of a bid, but there's sellers in there offering supply. Market comes off. Boom. Trades lower. Again, E-minis, 4-range chart. Market's coming off just like the crude. Catches a bid, starts ticking back up. Someone's got supply. They're offering it right out here at the high of this bar. Boom. Look at this. What's the volume trade underneath it? 1, 32, 26. That's nothing compared to 47, 56, 66. E-minis, also high of the day this time, 1,420. There's 1,420 traded here. Market couldn't get past it. There's somebody absorbing all that buying. If you're that buyer thinking this is it, we're hitting the high again, we're going to break out, but there's someone absorbing it, you're stuck. You're going to get trapped in the market. And what happens on the way down? Look at the volumes: 544, 414, 116, 187 against what? 336, 329, 56, 82. There's no math involved, nothing like that. It's just common sense. Now this is an interesting one. This was NASDAQ yesterday. There was this big bid in here, 182 contracts, right? The market starts rallying up, comes off. There's a big buyer in here. This is about understanding where the paper is in the market. If you see that, something like that, that's telling you somebody stepped in and is supporting this market. This is very good information, to use as a trader. And what happens? Boom, over the next 5 minutes, it was a 30-second chart. Over the next 2 minutes, market rallies, about 15, 20 handles. So the next one I talk about is the overwhelming imbalances in a bar. And I sort of talked about it earlier on that previous example, is when there's more than 5 imbalances, right? So this is, my software will put a box around it. It'll put it purple. So you can just see really quick. This one is very simple. It's a visual setup. You got a box around it. You were sort of breaking out of an area. Boom. Okay, I get long in the next bar. Look at that, from 53 all the way up to 58, new highs of the day. It doesn't take, it doesn't take rocket science. There's some science involved, but it's not rocket science. Again, here's another one, from 08, 09, all the way up to 15 in the next bar. You're looking for the signs in what's happening in the market before the move happens, right? You're not analyzing it down here after the move happened. No, you can see here, I see, oh my gosh, gold. I got big seller coming into the market. I've got 5 imbalances in this bar that has 10 price levels. That's probably important, right? And you see how the market sold off nicely. Now, again, I'd be doing you a disservice if I said, every single time it happens, it's a big winning trade. Sometimes what happens is the market goes sideways. You could do some analysis, obviously, say, well, gosh, if I got such a big bar, that's probably the move. Ideally, you'd like to see it happen on a smaller bar, not a bar that in the gold covers, $3. But you gotta, sometimes you gotta use your head. Even if you got short in here, okay, it's just going sideways. Cover it. Don't wait for it to come all the way back up to $3 against you to get out. There's euro currency, right? And you start putting the stuff together. This is a setup in here that I talk about a lot with my users, the ratio and divergence. But here's multiple imbalances go sideways before falls over. Now today, just in the morning, really quick, I want to talk about this. This was NASDAQ, 1 second chart. Again, I don't advocate people trade on a 1 second chart, but if you got to really be a gunslinger. What happened, right? Leading up into this move, right? That's the move. What do you see? Tons of buying imbalances here, buying imbalances here. Yeah, you got some selling imbalances here. Okay, one order, but more buying imbalances coming in. What are you going to do? Put a gun to your head, get long or get short. You're going to get long. And look what happened. Boom. Next second, 1 second, market went from 94 all the way up to 17. Next couple of bars, up, up, up. This is a trade setup I talk a lot about for my users, a ratio and divergence. But again, multiple selling imbalances now, and the market comes right back down. There's a 30-point move up and a 30-point move down in all of about 10 seconds. So hopefully by now you can see how just two pieces of order flow, point of control and imbalances give you amazing trading opportunities. You just need to know what to look for. Again, if you're interested in my software, you go to orderflows.com/oft2, oft2.html, or just go to Orderflows and it'll take you there. Now, if you want my book, you just go to orderflows.com/book.html and it'll take you to this page. You got to enter your name and email address and click submit, and you'll get access to the digital download for it. So thanks, Jack. I'll throw it back to you, see if there's any questions from users or attendees.
Hey, Michael, great presentation as always. Just wanted to point out here that I did type in the box anyone that wants to get this free digital copy of Michael's order flow books. Just you can click the link right here. I typed it in. It's orderflows.com/book. You can just type it in there and you'll get the book. I know we've had great reviews on this book. This book, tell us about how you wrote it and what the purpose of was it, because we've had so many people respond back to us saying that it's been so helpful and they finally got an understanding of how the paper and order flow works in the markets.
Oh, sure, sure. I've been wanting to write a book for a long time. I used to keep a lot of, since going back to the 90s, I used to keep notes on everything that was happening in the market, but more fundamental stuff. I was never really a fundamentalist, but a lot of people that trade in the banks and commodity firms are big fundamentalists. And then as I started moving more away from fundamentals and getting more into technicals, probably around 2010 or so, I started making notes on what I was seeing in the markets, in the depth of markets. I used to be a big dome trader, because when you're trading through the exchange, basically the front end systems, early on, that's what you had. You had a dome. There was no, footprints or anything like that back in the 90s. And, you would just see things in the markets and you'd have to, sort of make a mental catalog of things. And then when I left JP Morgan, they had this thing. I couldn't do anything in the business for like a year, otherwise they'd come and sue you. But so I just started writing this. It took a bit longer than I had imagined. And, I just started putting down all my thoughts and talking with other traders about what we would see in the order flow. And, so this book is really sort of the culmination of 20 years worth of institutional trading and try to understand it from a trader's point of view rather than someone just sort of coming here and looking at a market and trying to put the pieces together. I like to sort of give traders a bit of a background on on why things happen in the market, and executing a 3,000 lot order versus executing a 3 lot order, there's a big difference and it's going to impact the market. And you have to sort of understand that mentality. But the thing with order flow is once it's executed in the market, it's there for everybody to see. So, as a trader, you need to know how to see it. And, that's one of the reasons why I wanted to have a book, because there's really no book on there, on the subject. There's just a lot of, random postings online and,
Right.
and people were very, people that were real, the original order flow traders, back in the day were the floor traders, the
Yep.
market makers and stuff. And that's just information that, I hate to say people take with the grave to them, but it was
Yep.
never really, shared and among other people. And I would see stuff online. I just like shake my head. I said, there's got to be a better resource for traders to go to. So that's how I decided to write the book.
Yeah, I'm so glad you did. I mean, I learned it all obviously from the floor, and I mean, none of us put it down in writing. I mean, it just got passed down or trained to the guy next to you. It never was put into writing, mainly because I don't think it's like, look, trading with a moving average that's been written about, thousands
Yeah,
of times, right? But I
right.
just don't think, the people from the floor aren't really the type of people in the old days that would be sitting down and writing a book. Let's be honest. So you're really not, you're really not going to get that from that type of crowd. I love the
Well,
guys
I
who
mean,
got, but you're really not going to
yeah, I
get it.
mean, honestly, it's one of those things where, it's just information. It's, you know, I look back now, it's like I was living overseas for, 15 years, and, I very rarely see my parents. And then when I moved back to the US, my dad would be telling me all these stories from when he was a kid. And then he's like, I'm just telling you these stories because if I don't tell you, they'll be lost forever, when
Yep.
he goes away.
Yep.
And it's a bit like that with trading. I mean, there's so much knowledge there's so many good traders, on the floor that, it's just I hate to say it's a waste, but there's so much information that, that they have on trading that, they just never it's just never going to come out for people. And that's why I like doing, these presentations like this. Is just sort of, to share the knowledge, and hopefully, somebody somewhere can, get that information and become successful in their career or in their trading with it.
And with that, everyone should download the book because once Michael goes away, he's gone, and then the information is gone forever too.
Right, right,
Hopefully that's
right.
not. Hopefully that's not for a long time. But
Yeah.
anyway, all jokes aside, the book is super useful. I mean, really useful. There's a million books on trading out there nowadays, and this is one that it can be applied to any market. I mean, any market where you can actually see depth, a level two, or order flow, or any of that. This can be applied to, which is pretty much all of them nowadays. So there's no doubt that this is helpful. I mean, of the hundreds of people in the room, every single person should be downloading this book. There's zero reason not to. It's orderflows.com/book. And I've typed it in here, the window. Actually, you have HTML. Let me just click it, make
Yeah.
sure. Oh, that doesn't work, actually. So I got it. Let me retype it in here.
Okay.
Okay, let me make sure that works. That just took us to, there we go. That goes to the right
Okay.
one.
Yeah.
Yes, lots of people saying that they couldn't get it from that link. Apologies, it is .html at the end. And so, I mean, some of the questions people that are asking on here, I'm just going to kind of sum up a few of them so you can kind of go through. But some general stuff. Does this work with any type of trading platforms? Does it work with stocks and options? I mean, I know the answers, but go ahead.
Yeah, it's the there's so many different platforms nowadays. Obviously my software works with NinjaTrader. I have a partnership with a guy that has it for Sierra Charts. TradeStation, I don't know if they have it, but there's a lot of software now has versions of a footprint. So whether you have my software or not, you can take what I've applied as long as you have a footprint chart on your software, just a native volume footprint chart, you could apply what I was talking about. You just got to look for it. Now, does it work on stocks and Forex? Well, the problem with Forex is the data is not centralized, so you have a lot of different sources of data, and people don't realize that all of these brokers that they trade with, these small brokers, are actually front ends coming from banks like Goldman Sachs or Barclays. And so there's different bid asks and slightly different data that's coming out. So, I know people that use order flow, use the volume footprint chart. They watch the CME data and then they trade in the forex market. For stocks,
Oh, cool.
it really depends. You should have, I look at stocks, but I look at the main big stocks that trade a lot of volume, right? Because you're trying to analyze volume, so you should have something to analyze, basically. So I tend to stick to the bigger stocks like Apple and et cetera.
Right. Right. Understood. Totally understood. Well, cool. Thanks for being on the show, Michael. Always awesome. Super insightful. Everybody should download the book. Click the second link I typed in it, the actual correct one. And it's always great having you here. Any last comments before we go?
No, again, thanks for having me here. And again, people, trading is a journey, right? You got to start somewhere, but the important thing is you got to start. And, if you ask a lot of traders where they are now versus where they are 1 year ago, they find that they take a lot of twists and turns. Stay the path, stay the course, and you can get to the finish line as long as you're willing to put in the time and effort, basically.
Great, good information. Thanks, Michael. Have a great rest of the
All
day
right.
and
Yep.
rest of the trading week, and we will see you again here soon.
All right. Bye-bye.